Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today's first topic is about a concerning trend we're seeing in Canada's mortgage market. According to the latest data from the Canadian Bankers Association, mortgage arrears in the country have risen to their highest rate since early 2021. The national mortgage arrears rate hit 0.22% in January, which is a significant increase from the record low we saw in mid-2022. This is a 57% jump, and while the rate is still below pre-pandemic levels, it's getting uncomfortably close.
It's definitely worrying, Steve. Mortgage arrears are often a sign of financial stress for households, but the report suggests that this is more of a liquidity issue. When the housing market is booming, people can sell their homes quickly if they're behind on payments and avoid default. But with the market cooling down, it's not as easy to find buyers, leaving borrowers without that option.
Right, Janine. This uptick in arrears is happening alongside a slowdown in both new and resale home activity. Rising interest rates and global economic uncertainties, like the ongoing trade war, are squeezing liquidity further. It's making it harder for borrowers to manage their payments or sell in time to avoid default. What's particularly concerning is that arrears started rising even before the trade war intensified, despite efforts by policymakers to work with lenders and struggling borrowers.
There's a bit of a silver lining, though. While arrears are rising, housing affordability has improved somewhat due to falling interest rates. The decline in fixed mortgage rates, which began even before the Bank of Canada's first policy rate cut, has helped reverse years of affordability deterioration. According to RBC, more than 80% of the improvement in the National Affordability Index since the fourth quarter of 2023 is due to lower borrowing costs.
Yes, Janine, and that's crucial. By the end of 2023, Canadian homeowners were spending less of their income on mortgage payments, property taxes, and utilities than they were a year earlier. It was the fourth consecutive quarterly improvement. However, affordability is still strained in many of the major markets, like Toronto, Vancouver, and Victoria.
Absolutely, Steve. RBC Economics pointed out that cheaper borrowing costs have been beneficial across Canada, especially in those pricier markets. The recent shift in affordability came just in time, after a period of surging home prices and sharp interest rate hikes. It's a complex situation, and we'll definitely be keeping an eye on these trends as they develop. Our next topic is a recent announcement from Jagmeet Singh, the leader of Canada's New Democratic Party. He's proposing a new initiative aimed at helping first-time homebuyers by introducing low-interest, government-backed mortgages. This could be a significant development for those who've been struggling to enter the housing market, especially in areas like Metro Vancouver and the Greater Toronto area where prices have been soaring.
That's right, Janine. Singh's plan involves offering fixed-term mortgages directly backed by the federal government. The idea is to reduce interest rates, which could potentially save borrowers a considerable amount of money. For instance, a reduction of just 0.5% on a typical mortgage could save a family around $9,500 over 5 years. Singh's approach is to treat these loans similarly to how the government already backs loans for large developers, which he argues is a fair way to support everyday Canadians.
It's an interesting perspective, Steve. Singh also mentioned that this initiative is about keeping the dream of homeownership alive. He emphasized the need for a mix of housing types, including cooperatives and nonprofits, which could offer more sustainable housing options for families. However, it's important to note that the details on the proposed interest rate or eligibility criteria haven't been fully disclosed yet.
And that's a crucial point, Janine. Without specific details, it's challenging to assess the full impact of such a program. However, this proposal certainly adds a new dimension to the ongoing debate about housing affordability in Canada, especially as it becomes a key issue in the upcoming election. Other parties are also making promises. For example, Liberal leader Mark Carney has promised to eliminate the goods and services tax on newly built homes under $1 million for first-time buyers, whereas Conservative leader Pierre Poilievre has proposed a broader exemption for homes sold for less than $1.3 million.
Absolutely, Steve. Each of these proposals reflects the different approaches the parties are taking to tackle the housing crisis. Singh's focus is clearly on making it financially easier for first-time buyers to secure a home, which could be a game changer for many Canadians. Still, we'll have to see how these promises are received by the public and what impact they might have on the housing market if implemented.
Our next topic today is the recent movement in the Canadian 10-year bond yield, which has seen a notable decline. The yield has dipped below 2.95%, approaching the two-year low of 2.83% that was observed in early March. This has been influenced by weak economic data and escalating trade tensions, which have heightened expectations for further monetary easing.
That's right, Steve. It's a significant shift, and it's largely driven by the Canadian Manufacturing Purchasing Managers Index, which fell to 46.3 in March from 47.8. This marks its sharpest contraction in 15 months, with new orders dropping to their lowest level since May 2020. These numbers are quite concerning, especially as they reflect the growing worries over tariffs and trade disruptions.
Indeed, Janine. The preliminary data also showed that the gross domestic product was essentially flat in February, which reinforces fears of an economic slowdown. The Bank of Canada has already indicated a readiness to extend rate cuts to mitigate the effects of the ongoing trade war on exports and economic growth, which is contributing to the decline in yields.
Yes, and there's also added market anxiety with President Donald Trump set to unveil his reciprocal tariff plan, known as Liberation Day. The details are still uncertain, but there are reports suggesting that the administration might impose tariffs of about 20% on most imports into the United States. This uncertainty is definitely weighing on the markets.
It's a complex situation, Janine. The potential impact of these tariffs could be significant, affecting both the Canadian and global economies. While the bond yield decline might suggest a move towards monetary easing, it's important to keep an eye on how these geopolitical factors play out. They could have far-reaching implications for economic policy and market stability.
Absolutely, Steve. As we continue to monitor these developments, it's crucial for investors and borrowers alike to stay informed. The shifting economic landscape, coupled with trade tensions, means that decisions made today could have long-term effects on financial planning and home ownership goals. We'll be sure to keep our listeners updated as these stories evolve.
Let's discuss the recent financial results announced by Firm Capital Mortgage Investment Corporation for the fourth quarter of 2024. Their net income rose significantly by 9.9%, reaching over $9 million for the 3 months ending December 2024 compared to the previous year. For the full year, the net income increased by 3.1%, totaling over $35 million. This growth, while modest, is a positive indicator of their financial health.
I agree, Steve. It's encouraging to see that despite the challenges in the real estate market, Firm Capital has been able to grow its net income. This increase suggests they're managing their investments well, maintaining stability for their shareholders. With the market's volatility, having a steady income stream can be reassuring for investors looking for stability in their portfolios.
Absolutely, Janine. Their earnings per share for the quarter also saw a slight increase, moving from 24 cents to almost 25 cents per share. However, for the year, there was a small decline in earnings per share from 99 cents to 96 cents. It's a minor dip, but it does remind us of the competitive pressures and the need for strategic management in the mortgage investment space.
That's a good point, Steve. Even small changes in earnings per share can reflect broader trends in the company's operations and market conditions. It's important for investors to consider these figures within the context of the overall economic environment and the real estate market's fluctuations.
Speaking of investments, Firm Capital's portfolio grew by 9.3%, reaching over $653 million by the end of 2024. They added new investments totaling $329 million, which is a significant jump from the previous year's $249 million. This expansion indicates their active role in the market as they continue to seek out and fund new opportunities.
It's impressive to see such growth, Steve. The increase in their investment portfolio not only shows their capability in identifying opportunities, but also their confidence in the market's potential. A larger portfolio can provide more diversification, which is essential for managing risk, especially in uncertain times.
Another aspect worth noting is their prudent approach to managing risk. The allowance for impairment and fair value adjustments increased to $29.6 million from $22.7 million the previous year. This increase suggests they're preparing for potential risks and ensuring their portfolio remains robust against market fluctuations.
Yes, Steve, and it's crucial for companies like Firm Capital to have these safeguards in place. By setting aside a higher allowance for potential impairments, they're protecting their investments and ensuring they can weather any downturns in the market. It's a responsible approach that can help maintain investor confidence.
Additionally, their dividend and share purchase plans are quite attractive. For 2024, they declared dividends totaling over $35 million, with a slight increase in dividends per share. The Dividend Reinvestment Plan and Share Purchase Plan offer shareholders a way to reinvest their dividends and purchase additional shares without commission costs, which can be a great way to build wealth over time.
These plans are indeed beneficial for shareholders, Steve. They not only provide a steady income stream, but also offer a cost-effective way to increase their holdings in the company. This can be particularly appealing for long-term investors looking to capitalize on the company's growth potential.
In summary, Firm Capital's results for the fourth quarter and the full year of 2024 reflect a company that's navigating the challenges of the real estate market with strategic growth and prudent risk management. Their performance indicates a well-managed portfolio that's positioned to continue providing stable returns to shareholders.
I completely agree, Steve. It's refreshing to see a company that not only focuses on growth, but also prioritizes the protection of its investments and the interests of its shareholders. As we move forward, it'll be interesting to see how they adapt to any changes in the market and continue to deliver value.
Our final topic today is a significant milestone for TMG The Mortgage Group, which is celebrating 35 years in business and ushering in a new generation of leaders. This change in leadership is not just about succession planning, but also about strengthening the company's commitment to innovation and the brokerage channel.
That's right, Steve. TMG's Chief Executive Officer, Mark Kersner, is stepping away from his role as president to focus on strategic governance. This move aligns with the company's growth and the increasing complexity of the mortgage industry. Dan Poulter, who was the Senior Vice President of Strategic Initiatives, is now taking over as President and Chief Operating Officer.
Dan Poulter brings a wealth of experience, having joined TMG as the Director of Sales for British Columbia in 2011. His journey through various roles within the company has prepared him well to lead TMG into its next phase. His promotion is not a shakeup, but rather a natural progression, as Kersner put it, to ensure that TMG continues to thrive by having leaders who can drive the business forward while maintaining its core values.
Absolutely, Steve. It's also important to note that TMG is not just focusing on leadership changes. They're also bringing in new talent, like Krista Mitchell, a former Chief Strategy Officer at Pineapple, to replace Poulter in his previous role. This indicates TMG's commitment to strategic growth and innovation as they expand their reach across Canada.
TMG's evolution from a regional brokerage to one of Canada's largest independently owned brokerages is quite impressive. Under Kersner's leadership, the company has maintained a broker-first philosophy while significantly expanding its impact and reach. This has been crucial in adapting to the ever-changing landscape of the mortgage industry.
Indeed, Steve. As TMG celebrates its 35th anniversary, they're focusing on not just maintaining, but enhancing their existing partnerships, like those with Mortgage Outlet and SafeBridge Financial Group. They're also investing in technology to empower their brokers and staff, which is vital for staying competitive in today's market.
It's clear that TMG is committed to not only growth, but also to providing their brokers with the resources and support they need. This includes strategic partnerships and continuous investment in technology, ensuring their agents are effective and productive. It's a forward-thinking approach that's essential for their success moving forward.
TMG's dedication to innovation and support reflects their understanding of the industry's needs. By providing enhancements to their tools regularly, they're ensuring their brokers are equipped to handle the market's demands. It's this kind of leadership and vision that will keep TMG at the forefront of the mortgage industry.
In summary, TMG's leadership transition and strategic initiatives position them well for continued success. Their focus on innovation, partnership, and broker support highlights their commitment to leading the industry and adapting to its challenges.
Exactly, Steve. It's great to see a company that values its people and partners while driving innovation. TMG's future looks bright as it continues to evolve and adapt in the ever-changing mortgage landscape.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.